Welcome back to Ask the Compound, the show where we have the highest per capita intelligence of any audience on YouTube. It's a pretty low bar, if we're being honest. Fair? Today's show, we'll be tackling viewer questions about how to use stock market valuations to time the market, if you can, maximizing after-tax savings in different tax-deferred retirement accounts, the 401k trap. This is something I had to Google. I did not know that was a thing, and when it makes sense to avoid maxing out your 401k, rolling over an inherited IRA after the passing of a relative, and the tax consequences of retiring abroad. Remember, our email here, askthecompoundshow@gmail.com. Welcome to all the live viewers. We appreciate you on Twitter, on YouTube. Thanks for leaving your comments and questions. Today's show sponsored by Fabric by Gerber Life. Fabric by Gerber Life is designed by parents for parents to make it easy to plan for and manage your financial path. With a kid's investment account from Fabric, you can start investing in your child's future today. This is nice. I like the little pictures of the kids on there. It makes you pulls your heartstrings a little bit. This is great because we're getting questions all the time from people about, I want to save for my child. I want to have that compounding benefit Ben's always talking about. Funds can be used for nearly anything benefiting your child. Tuition, books, summer camps, after-school activities, band practice, all that stuff. All online. I went through this process. It's very easy. Setting up an account could take just 5 minutes. You can get started with as little as $1 a day. Very few minimums. And no contribution limits, there's multiple tax advantages, it's no commissions, it's a flat monthly maintenance fee, pretty easy. Join the thousands of people who trust Fabric to help protect their family. Start investing in your child today at meetfabric.com/ATC. That's meetfabric.com/ATC.
I love we have our own link. It's always nice.
Yeah, we made it. All right, let's get into some questions. Good ones today. One long one, maybe, for you?
Also, I should just say, for those that didn't realize, that intro is one that Dan made for me that is zooming in on a field of oats. So that's what that intro was. But I kind of like seeing you score a touchdown on that intro before every show.
The oats almost put me to sleep, but it was very soothing.
True. All right. Up first today, we have a question from Aaron. My asset allocation has been pretty conservative since the market run-up in 2020. My basic thesis is that the market is overvalued, and the only way I can keep myself in equities at all is to have a 60-40 allocation. One thing I like about having a 60-40 split is that it gives me the option of changing to a more aggressive allocation if stock valuations fall. I'm 41 and have nagging doubts that my allocation is not aggressive enough, so I've been thinking about how I could convince myself to be more aggressive. Over the last week, I've been trying to commit a simple strategy to paper. Ideally, my strategy would have a line like, if X metric of market valuation goes below Y, change to a more aggressive asset allocation. This has made me realize that I don't know a good way to do this. I've used the cyclically adjusted PE of the S&P 500 to convince myself that stocks are overvalued, but I don't know if it can be used as an indicator for my plan. Price to peak earnings seems like another option. I'm curious if you can offer a better method or indicator, or if you hate the idea of this market timing light in general.
Okay, let's start with what I like about this question. There's a lot to like here. I like the fact that this person didn't say, the stock market is overvalued, so I'm going to completely get out. They say, I had to use 60-40 because that's the only way I could stay in stocks in some fashion, right? Because they think that the stock market is overvalued. I like the idea of having some sort of pre-established plan, right? You take your lesser self out of the equation, especially during bear markets, which they're kind of thinking about here, and putting money back to use in the stock market. So I like the fact that they're trying to pre-establish rules to guide their actions. It also makes sense to use your fixed income as dry powder, right? Buy the blood in the street sounds great, but what if you have no sources of liquidity? So that money's got to come from somewhere if you want to get aggressive in stocks. So over rebalancing too also kind of makes sense, right? When things get bad, then you go overboard into stocks. When you're not feeling so great, you go back into bonds. Where Aaron lost me here is using valuations to time the market. I've simply never found a legitimate way to use valuations as a timing indicator for entry and exit points. I mean, maybe when things get to extremes, then sure, but even when that happens, it can be unreliable. So John, throw up my first little thing here. In early 2017, I wrote a piece for Bloomberg about stock market valuations, and they titled it, which I didn't have a say in the title, What to Make of These Twice in History S&P 500 Valuations. And let me read you the lead of this one. Which, Duncan, do you know why it's LEDE instead of LEAD?
I knew this, but I don't remember.
Yeah, it doesn't. It's something about printing at papers. I don't know. I wish I had a better answer. Something happened in the stock market this week that had only occurred twice since 1871. I remember I wrote this back in March of 2017. Robert Shiller's favorite valuation method for the S&P 500, The cyclically adjusted price to earnings ratio reached 30. So is it time to worry? ... John, throw up the next chart here. This is the chart I used at the time. And the CAPE ratio was above 30 for the first time since 1929 and 2000, the two biggest peaks in stock market history at that point. So in 2017, everyone's going, oh my gosh, this has got to be a rerun. This is crazy. And since then, the S&P 500 is up nearly 170%, annual gains of 14% per year. So again, like the third highest CAPE ratio ever. And we've had 14% returns since then. So sometimes valuations matter, sure. Other times the market doesn't care about your ratios. Oh, cute. You divided this number by that number? Great. I don't care. The same is true during bear markets. Sometimes stocks get downright cheap, but other times, they don't get to levels you want. So I looked at the CAPE ratio, the trailing 12-month PE ratio, and the dividend yield. Remember, the CAPE ratio is looking at the previous 10 years inflation adjusted of earnings. Trailing 12 months is just the last 12 months of earnings. John, throw up this next chart. This is every bear market bottom since the end of World War II. So I think there's like 13 bear markets here. And I looked at the CAPE ratio, the PE, the dividend yield, and you can see in like the 50s, 60s, 70s, valuations got really cheap at the end of bear markets. And it's like just salivating at, in the 70s and 80s, we're talking like single-digit PE ratios. Just unbelievably cheap. Bond yields were higher, inflation was higher back then, sure. But if you just took the averages here, you'd say, that's a pretty solid entry point. I'm going to get in at like a 15 times CAPE, right? Or a 12, 13 times PE. Dividend yield hits 3 or 4%. I'm going to get in. In the past, that might have worked great, but 3 out of the 4 bear markets this century didn't see a CAPE ratio come close to that previous average. In 2009, it did briefly hit 13, but we're still talking about in the 20s in the 2020 bear market and the 2022 bear market. So, John, you can do chart off. So the problem with using valuations as an indicator is that even if they work on average, missing out on just one bull market can be devastating to your portfolio. So you could be waiting a long time. So I'm not a big fan of... What's up?
Oh, okay. It was on me. Never mind. Sorry. Continue on.
Yeah. Get out of here. It's all your radio.
I'm having technical issues today.
All right. So I'm not a big fan of market timing in general. But if you do want to get more aggressive during a bear market, I would rather use a very simple strategy. Instead of trying to figure out valuations, and I'm going to use price to book or price to earnings or price to sales or whatever it is, and try to form fit some valuation method, I would just use predetermined loss levels, right? Every time stocks are down 10%, I'm going to put more money into stocks. Every time they're down 20%, I put a little more in. Every time they're down 30, whatever the number is, pick a number ahead of time, move a specified amount or a certain percentage of your asset allocation back into stocks. That's a simpler plan. It takes away all the craziness of valuations and how they can be screwed with, because for a time in 2008 and 2009, price to earnings ratios skyrocketed because banks lost so much money. Earnings went like negative essentially, and that screwed up the price to earnings multiple. So the valuations didn't make any sense. So there's been, like I said, 13 bear markets since 1945. We're talking one every 6 years or so on average. 2/3 of all years see a 10% correction. So I don't know. Again, averages are never average, but you can't set your watch to these. But I would just pick a loss level that you're like, 20%, I'm going to move more into stocks. I'm going from 60-40 to 70-30 or 80-20 or whatever it is. Use that as your rebalancing plan. So again, the good news is Aaron didn't completely get out of the stock market. He knew, listen, I think stocks are overvalued, but I'm not going to completely get out. The 60-40 is going to allow me to stay in there. But I would just, put it at a level. Now, the hard part about that strategy is you're not guaranteed to see stocks fall anytime soon. Maybe they will because you think valuations are high, but it's not necessarily guaranteed. So I think market
recent
timing
years
is
have
hard.
shown us that bonds and stocks can fall together, right?
Yes,
And
yeah, exactly. So yeah, there was a time, he said he's been doing it since 2020. 2022 probably would have been a pretty good entry point, right? So my whole thinking is market timing is hard. Valuations don't make it any easier.
It does feel good when you buy a stock and you see that it has a really low PE. There is something about that that feels nice. I like it.
Yeah, it's always fun catching a falling knife.
Yeah.
That's great.
True.
All right, next question.
Okay, up next we have a question from Curtis. I'm 53 and contributing the max, including the catch-up provision, to my Roth 401k. The 401k also allows me to contribute pre-tax dollars. My question is this. If instead of Roth contributions, I contributed in a pre-tax fashion and was disciplined and invested the tax savings into a tax-efficient broad market index in a taxable account, would that be better than the Roth contribution? It's a lot of tax.
Put out the Roth signal here to Mr. Bill Sweet, Mr. Roth himself.
Gentlemen,
Hey, Bill.
broadcasting you live from my 2002 Jeep Wrangler. I heard Roth and I drove down from Maine just
Looking
for Curtis. Yeah,
How
thanks.
many miles on that bad boy?
It's not a lot, actually. About 140,000, right? So, yeah, it's not a daily driver, just locally. Got the 2 car seats for the kids in the back. A+. Strong recommend.
Okay, and the kids like having the top down?
Oh, yeah. Yeah, it's the best. Yeah.
Okay.
Because, it's not a fancy car. It's just a giant bucket of bolts. John Grayson in the chat knows. He drives a 2007. It's a lot fancier than this bucket of rust. But, no, it plays, Ben. The kids love it.
You can change
I
the
like
oil without having to lift it. Right?
Exactly.
It's nice.
Yeah. And you can stick your hand in there. There's no software you need. You check the oil with a dipstick, like we've done for 100 years. It's great.
Never do I feel dumber than when I get my oil change and they show me the dipstick. They could show me literally anything. I've always made this joke that they could stick it in guacamole and show me, hey, here it is, and I'd say, oh, looks good.
I've never done this. What do? They give it to you in a box? Like how does
They
how does
they
this
dip
happen?
it and then they bring it over to you and they say, hey, see, it's all the way to the top, and it's like, sure.
Wow.
Like what am I gonna say? Nope, do it again.
That's great.
Just
That's
make sure
great.
they put the plug back in. But This
Exactly.
isn't a car show. This isn't a car
This is
show
key.
right now.
Exactly.
All right,
Let's
Bill,
get back to Curtis.
first of all, remind me, what is the catch-up provision? If you're over 50 years old, you can put how much more into your 401k?
You can kick in another $7,000. I think it's $7,500 this year. But yeah,
So
Curtis
we're talking
can-
like 30 grand ish.
Yeah, 30,000. That's exactly it. Yep, and that is indexed for inflation. It increases every year, similar to the IRA limit. But notice that you can put a lot more into a company-sponsored 401k, 403b, 457 plan than you can into an IRA. So yeah, $30,000 a year adds up as it did for a guy.
I like the
Curtis.
catch-up because Bill, you and I have kids. Kids are expensive. Once they get out of the house, then you play the catch-up if you're cut back on your retirement savings to help the kids out, right?
Yeah, it's great. And I think you have to balance that future opportunity. Let's say in your 20s or 30s, that's still 20 years away versus the time value of money, right? So dollars compound. So what Curtis is asking about is Roth versus traditional. That's what this question is. We deal with this a lot when it comes to Roth IRA conversions here on this show and with our clients. And my thesis, Ben, this is supported by academic research by Christopher McQuarrie and others in the University of Santa Cruz, that on a long enough timeline, Roth IRA will always win. Roth 401k will always outperform because you're getting tax-free compounding. The problem with a long enough timeline, Ben, is what?
Yeah, at a certain point we're dead. So he's in his 50s
Exactly.
already. Does he have enough time to allow that compounding? And the other thing is, most people don't figure out the tax savings and then reinvest the difference, right? He's saying, no, I'm going to do that. So what's the break-even point here?
Yeah, that's
it has
great.
To be at some point.
Exactly. And so that was exactly the question that I asked. It's not if you want to contribute to a Roth, but when. So, John, can we chart on and show the data here? I think magically for our guy Curtis, it's around your mid-50s when you want to flip that switch. And the reason, again, back to the Macquarie paper that I referenced a few minutes ago, if you'd like to Google it, Christopher Macquarie Roth conversion PDF, you can see based on the red lines in the chart, there's a temporal arbitrage of Roth versus traditional, and the break-even point for most taxpayers, assuming a similar taxable marginal tax rate during contribution versus distribution, is around 17 years. And so it does take almost 2 decades at the same tax rate for a Roth conversion to pay off relative to a traditional at the same contribution rate. And then at that point, you're good, but that's 17 years. And so if Curtis is mid-50s, let's say 53, 17, 18, 20 years from now, he's in his 70s, right? And that's when RMDs begin to kick in. That, to me, Ben, is around the time, usually mid-50s, kind of late 40s, mid-career, that you'd want to pivot and move less from Roth and more into a traditional bucket.
So he might be onto something here then.
I think so. But what Curtis's question is, too, he had a two-parter, right? He said, first off, should I be contributing? I think always yes. But then the second question was not a Roth versus traditional. It was, should I be investing in a taxable non-qualified account? And there's some trade-offs there. So what you get is flexibility, right? Is that you can tap into those funds whenever you want to. There might be capital gains consequences, but you're not paying this extra 10% penalty for an early distribution, which you would have to deal with. Curtis is not that far away, but someone else. However, there's this process tax drag, right? Assets within a tax-qualified, a Roth traditional account, they're shielded from taxes, right? No matter how much income that makes, no matter how many capital gains or losses you generate within the account, it's not getting hit. It doesn't translate to your tax return. So there's a bit of a trade-off there. It's usually about 40 or 50 basis points of lower returns from a taxable account just due to the fact that you have to pay tax on dividends and gains each year.
Right. But does it make sense in your 50s to add some of that flexibility just in case because it gives you some tax diversification potentially when you're withdrawing funds? Or do you
think
not
so.
really subscribe to that?
I think so. I think it does make sense, Ben, because ultimately, yeah, until you get to 59.5, you're not taking a tax-free distribution. I guess just my thing about Roths are, I'm always a fan of adding as much Roth dollars as you can. If you're in the habit of doing that $30,000 contribution every year, God bless you, that will compound. We're going to get to the compound effects here in question number 3. So I don't see any difference, right? If you're contributing to the Roth, fine, it might be locked up for a couple of years, but you can always get your basis back tax-free, right? For most Roth IRAs, if it's in a company plan, you just need to roll it over to an IRA first. So I think for me, I would always fill up the Roth bucket first.
So the good news is we're splitting. We're at the point of splitting hairs. In whatever he does, any of these routes, he's going to be pretty good.
Correct. I think so. And you're winning the game if you can afford $30,000 of savings every year.
Yeah, if he's putting aside $30,000 a year, he's going to be pretty well set for retirement.
But why not do a tax-free, Ben? With a Roth contribution, presuming your plan allows it, you can take a distribution tax-free and just get your basis back, right, at any time. And so I don't see any reason not to continue that process unless there's something on the horizon that he wants to save for.
Yes. Good deal.
Cool.
All right, next one. We got another 401k one next.
Okay, up next we have a question from Daniel. We have a lot of Dans and Daniels on the show today. The 401k trap, which I've never heard of, so looking forward to hearing what that even is. The 401k trap is a big topic I see on finance Twitter. So I thought I'd ask. My wife and I, age 32, are fortunate to have a combined 401k value of $770,000.
Jeez.
Not to brag. Yeah, pretty good.
32?
Yeah.
Solid.
Well, this is the part, the real not to brag. It makes up about 35% of our net worth. I'm not great at
they
math,
definitely
but that
work in
sounds good.
tech. They definitely work in tech.
Would you stop maxing out your 401k, only put in enough to get the company match, and put money into a more flexible account? Is there a point where it's enough and it makes more sense to find other investment avenues? It never feels this way, and it's hard to believe the hockey stick compounding growth that will come in the future.
We've got to come up with a scale of not to brags, because if you do it this young,
Yeah,
that's pretty darn good.
That's a good one.
Duncan, I'm like you. I'd never really heard of the 401k trap before. I guess I'm an out-of-touch middle-aged personal finance guy. I had to Google it, and I did Google it, and a bunch of scary videos popped up. And it's essentially this idea that your money is trapped in a 401k until you're whatever age, 59 and a half.
59 and a
you
half,
can't
yeah.
get it out. So they were painting the long-term nature of 401ks as a bad thing. Like, your money is stuck. You're trapped. It does you no good. Personally, I think the fact that your money being trapped in a 401k is a great thing for most people, because it's a behavioral hurdle. You can get it out, but you have to pay the penalty and the tax and all that stuff. But I think it forces people to become a long-term investor, which I think is a huge net positive for people, because you think that money is out of sight, out of mind. It forces you to hold it for longer. So that's the 401k trap thing. So again, Bill, early 30s, huge
Yeah.
401k balance. I'm guessing some of that has to be in like company stock or something. They could obviously run the numbers here and just let that money ride and say we're going to go all taxable to give more flexibility. But at that age, the tax deferral is huge. They're 20 some years younger than Curtis from the last question.
There you go.
That deferral to me has to be worth way more in your 30s than it is in your 50s.
Yeah, I would agree, and I would reference, Ben, for people who want to kind of dig in a little bit, is to read Ritholtz Wealth Chief Operating Officer Nick Maggiulli has written at least 2 to 3, maybe 4 blog posts on this topic at dollarsandData.com. And his argument, because we have a diversity, Ben, as you know, of viewpoints here at
Nick
Ritholtz
is
Wealth Management.
anti-401k.
I wouldn't say he's anti-401k. He's just more pro-flexibility, right? And so
Yes.
that is the question that Daniel is asking. So, Ben, let's do some quick compound math. $770,000 is a massive retirement account at 32, because if you just use rule of 7, that's $1.5 million at age 42. That's $3 million at age 52 when we hit Curtis's age, and that's $6.1 million, assuming that we get a steady, roughly 7% rate of return at age 62. Now, we need to do some inflation
So
math.
at what point are they wealthy then?
I would say now. But big picture, we need to do some inflation math in real terms, assuming a 3% real return. That's about $1.8 million in today's dollars, right? And so if we just use, it's traditional rules of thumb, $75,000 would be a 4% annual distribution on an account balance that size. Let's add $50,000 Social Security benefits, because I'm assuming, Daniel, you and your spouse are high earners, right? That's a pretty good presumption if you're able to accumulate this much. You're looking at about $125,000 of today's dollars in retirement income, just based on this single account and Social Security. So, Ben, if $10,000 is enough of pre-tax income to live on a per month basis, it would be for me personally, the way I run my life with my 22-year-old cars. I think that's a great thing to look at for Daniel, because ultimately, Ben, one of the things that you preach, and I'd love to put you on your soapbox, a lot of life is going to happen between age 32 and 62, right? And so if Daniel, it's a question of trade-offs. If you think that $10,000 a month of pre-tax income in today's dollars is enough to live on, what are you doing max funding a 401k? It's a valid question for Daniel to ask, I think.
Yes, I agree. So you can add to the flexibility. I don't know what the rest of their net worth is in, if this is only 35% of it. If they own a $4 million home in San Francisco because they work for NVIDIA or whoever, I hope that if they do have a lot of money in tech stocks that they're diversifying some of it, and that could be the pain point eventually if we're doing these compounding numbers like our tech stock is down 80% or whatever it is. I also asked her, do you need the money in the coming years that would be worth missing out on the tax deferral?
Yeah.
Right? Are you going to have to buy a new home? You have kids coming. You want to retire early? Whatever it is, think through that trade-off.
Yep.
And then it doesn't have to be an all or nothing thing. Maybe you can still put in half the max for 401k and money somewhere else. But again, these have to be high earners unless they just hit the lottery on a RSU or whatever it is.
Potential inheritance. Yeah, I mean, that's possible.
Yeah.
We talked about it in the question before. I got my questions mixed up, unfortunately, but it's roughly about a 50% tax drag that you're looking at, 50 basis points, of annual returns that you're giving up by choosing to invest in a non-qualified account versus a traditional. So what I would throw at Daniel would be a spin. Again, we talked about it a question ago. Just maybe think about a Roth, right? You're going to pay the higher taxes now, but you will have access to those Roth contributions next year or the year after. You can basically always pull your money back. You just have to leave the earnings alone. But Ben, to your point, then you get the best of both worlds. You get the behavioral hedge, right? Because the money's in a 401k. You get the tax shielding because it's compounding and it's tax deferred until withdrawal. But you also get the flexibility of potentially that you can draw off of that bucket if you'd like to in the next 30 years before you hit 59 and a half.
And personally, when I was young, I did everything I could to shovel money into tax-deferred retirement accounts. 20s, 30s, all of that. And then as I aged, then I decided, okay, I need to diversify a little bit in terms of my tax holding. And then I had more of I'm building up the brokerage side of things. But the tax deferral when I was young, that was the biggest thing that I wanted to focus on. And so, I think it's okay to diversify a little bit, but I don't think you have to let go of the 401k altogether. It's still
I would agree.
Nice
I'm
benefit.
kind of surprised to hear Bill come on here and preach Roths. It's surprising.
Shocker. Right?
I know. Yeah. David Ellie, Sean Graylish, they know what's coming in the chat. They're like, it's going to be a Roth question.
Do you think he's got a tire cover that says like Rothman on the back?
I should get one.
He
get one in the back. Yeah. That's my brand. Right. Just the tattoos so far.
Also, just for the record, I mean, you can take money out of a 401k. It's not like it literally isn't accessible if you're in some kind of emergency, but you just pay penalties, right?
Yeah, no, it's expensive. Yeah, it's a very expensive place.
But like if you had to, it's not like it's completely locked
That's
up.
Your next break even, Bill. What's the difference between the tax deferral benefit versus taking the 10% penalty?
Yeah, I've been thinking about it, Ben, actually, in terms of 529s, but more so that we're in a higher interest rate environment. So dividend rates are higher, right? Interest rates are higher. That tax deferral component is more valuable today than it has been during my entire career, right? Because we grew up in a low interest rate environment.
Right. Yeah, I heard a client recently complaining that, hey, my taxes are way higher now. And it's like, yeah, because bond yields are higher.
Exactly.
You're earning more income, so your taxes go up.
Yeah. People hate paying taxes more than they like making money, unfortunately.
True. All right. Next question.
Okay, up next we have, hey, Ben and Duncan, I'm a huge fan of everything you guys do at Rihos. I listen to every episode of Ask the Compound, Animal Spirits, and TCAF. This is what you call Die Hard.
Nice.
While I work in a totally different field, personal finance and the business of wealth management has always intrigued me, and I love your content. My brother passed away a few months ago, and I'm working through his estate. I inherited his 401k, and my question is if I'm able to roll that inherited 401k into my own IRA. One of the exceptions to the 10-year withdrawal requirement in Secure 2.0 seems to be that if you were within 10 years of the deceased, you can withdraw based on your own timeline. My brother was 27 and I'm 32. Everything I've seen about rolling into your own IRA is for surviving spouses. I can't seem to find clear guidance on this particular exception. So kind of a sad one. Sorry for the loss.
Sorry for the loss. 27. That's so young.
Way too early.
The hard part about a lot of this stuff is that finances are the last kind of thing you want to think about in a time like this. But the longer you wait and let those rules upon rules compound, then the harder it can be to untangle it. So a death in the family can be very confusing, especially at that age because you're not planning for it, obviously. Okay, Bill, what do we got here for the withdrawal requirement? So I'm curious on this. So he inherited his brother's 401k. Does the 401k rules apply to him in terms of when he can get it out? Can he take the money out? How does this work?
Yeah, so the Secure Act came in, Ben, it 2 rounds, right? 2019 and again in 2022, they updated it. And generally, the general rule is that there's a 10-year window in which you need to distribute 100% of the inherited asset, be it 401k, 403b, or IRA.
Regardless of your age or the deceased age.
That is correct. Generally, there are no RMDs required, minimum distributions required for general purposes for most account inheritors. However, in this case, we are getting an exception to the 10-year rule because, as we mentioned, less than 10 years younger, you basically have a special treatment that you can elect and apply the old pre-Secure Act inherited rules. And those were one of 2 options, Ben. Either you can distribute all of the account in 5 years, which no longer really plays because we now have this 10-year rule, or you can elect to do stretch IRA distributions according to your life expectancy. And those distributions would need to begin the year after the individual passed away. So we're talking the end of 2025. We would have an option to elect and begin lifetime distributions at that time. And if we make an RMD distribution each year, every year after, then you can stretch that out during your entire lifetime. It will always have to be a separate account. You cannot treat that asset as your own. However, you can stretch the distributions out according to your life expectancy because, again, unfortunately, involved the passing of your brother.
And it would just be like an RMD type of schedule?
Correct. And it's based on then your life expectancy. So at age 32, it's only 1.7% of the total account balance. So theoretically, if there was a $100,000 IRA, let's say, you would only need to distribute $1,700 annually. This is a waiver, a penalty exception, because, again, it wasn't your IRA. Unfortunately, the person died. However, you would then have to pay the income tax on the inherited IRA, assuming it's a traditional, it's not a Roth.
Right. So I guess you have to think, do you want to take dribs and drabs of this out occasionally and let it grow, or do you want to let it grow for, say, 10 years and then pull the whole thing?
Yeah.
Right?
No, but again, we qualify for exception here because of the less than 10 years. The RMDs could continue for your lifetime. And so as long as you make sure you make that annual RMD, this IRA can stay open until your untimely passing.
Yeah. It is tough because a situation like this, there are so many different rules and things to try to, it's just a mass web of issues to deal with.
It really is. Yeah, and we just covered this with our entire client service team, Colleen Parker, Lauren Lafferty, Erica Morrow, and the rest of our A-plus team on the side. It is extremely complex, and we've made the decision internally, Ben, we're going to handle this from the tax team, any inheritance, because as you said, the rules are extremely complex. The IRS and Congress did us no favors when they were making these modifications, in my opinion. It is extremely complex.
Yeah, I don't know if we got a name on this one, but yeah, if you have any other questions, reach out to us. We'll help.
Yeah, please. Would love to help.
This has to be a catalyst for a lot of people going and getting tax or financial advice, right?
Oh yeah.
Losing a loved one.
Yeah, especially if they didn't get it ahead of time.
Because I wouldn't even know where to begin.
It's a lot to deal with.
It's
emotional
you don't want to
too.
do something and then have to pay penalties or taxes or that's a huge mess.
Right.
It's very emotional too. Duncan, you ask an appropriate question.
Yeah, because it's your brother's money in this case,
exactly,
right?
Exactly. And I think there's always a part of you that thinks, what would my brother want me to do with this, right? And so you need to layer that on. And there's survivor's guilt. It's a thing, right? And I this is a different situation, but just as a military person, like that's something that has haunted me in the past. So a different situation, but yeah, if you have death touch you, it affects you in very strange ways. I think working with a professional is a great way to help navigate through that.
Yes, well said. All right, we got one more question.
Okay, last but not least, we have a question from our very own Daniel. This was a good one, an in-house one. I'm working in the U.S. and funding both pre-tax and Roth retirement accounts. Though retirement is many decades away, I've been curious about eventually retiring in another country as the cost of living in the U.S. is significantly higher than in most other countries. What would be the tax liability for both types of retirement accounts if I moved abroad? Would I be able to withdraw the pre-tax RMDs in the same manner as I would in the U.S., or would my country of residence change that? Would the pre-tax RMDs be taxed by the U.S. government only, or be subject to tax by the foreign government also? Would the Roth withdrawals be recognized as already taxed assets, or would they be subject to tax by the foreign government? What would you recommend the best course of action be for saving money to retire in another country?
Yeah,
Daniel, coming in off the top rope.
I should have made him
directly
read
to
that.
my inbox. Daniel on the production team, who is actually Daniel is originally from Venezuela.
Yeah.
Correct.
So if anyone
Raucous.
wants to complain about hyperinflation, it's him. So, Bill, what are we talking here? And you see all these stories on like Market Watch or the Wall Street Journal of people saying, "Hey, I retired in Mexico and I pay $400 a month for rent or something." It does sound like this is the kind of thing where if you choose the right location, there's other factors to consider that living abroad can be cheaper. Does it really matter, or does Uncle Sam chase you down to the ends of the earth to find you, and the tax implications are the same?
Yeah, the latter. Sally Mae and the federal government can find you, and they will eat your income. No, it really, unfortunately, it really does depend. So Daniel, first and foremost, U.S. citizens, until up and when you determine that you're going to relinquish your U.S. citizenship, you're required as a U.S. citizen to file a tax return in the U.S. regardless of where you live. And so that stipulation one is that until such a time you give up your passport, you're obligated to file a U.S. tax return. So the same rules would apply whether you're living in the U.S. or Costa Rica or abroad somewhere else. Regardless of where you go, you're required to do that.
Isn't it essentially that you pay the higher of the two tax rates?
I'm getting there. But the IRS does give you a 2-month extension. You're able to file your tax return if you're living abroad up to June 15th plus extension. But Ben, you're getting to an interesting, more complex question. Depending on where you go and whether there's a favorable tax treaty with the United States, very typically what the IRS will say is they're going to count any taxes you're paying to a foreign jurisdiction in U.S. dollars as a credit against your U.S. taxes due. And so this very much depends on where you end up retiring. One chart that I did not prepare and I don't have time to do a napkin would be the U.S. is about on the lower third of OECD countries, believe it or not, unless you're going to Saudi Arabia or another country that ends up funding their citizen through oil revenues or some other purpose. You're probably going to end up paying a higher tax, certainly in Europe or other states, because they have higher social safety nets, they have higher welfare programs, and that does end up coming out of the tax populace. However, depending on the situation, there may be a favorable U.S. tax treaty, let's say with the U.K., and the U.S.-U.K. tax treaty, as an example, says we're not going to double tax U.S.-U.K. residents, permanent residents, and citizens. If the home country applies a tax, the foreign country isn't, and vice versa. And that type of thing is actually really, really favorable, but extremely complex because it really comes down to the country that you're living in. However, I would argue to Daniel and anybody considering this is really a cost of living play. I think that's the thing, is that if you can spend $4 to get yourself a good meal in Mexico or otherwise, if you can spend $400 or less a month on rent, whatever you're going to pay in difference in taxes is going to pale in comparison to the $4,000 a month that you would pay to live in New York City.
Yeah, it'll be worth it. And you would hope in retirement your taxes are lower.
Yep.
So, okay, to your point, so that the tax implications aren't all that different. But
correct.
Yes, so the cost
you're
of
required to
living
file a
taxes.
tax return. Yeah. And I don't know. I'm a flag-waving patriot. I drive a Jeep. It's Labor Day. I'm going to be out there wrapped in the red, white, and blue. So I would say, Daniel, don't give up a U.S. citizenship. Pay your taxes, pay your fair share. But more than likely in retirement, just depending on your situation, tax rates are extremely low, right? We do not tax people's Social Security. FICA drops away, so you get a 15% savings there. And ultimately, hopefully, you'll fall into a lower tax bracket and get to live wherever you want to abroad at a lower cost of living while filing a U.S. tax return.
You see a lot of articles that talk about retiring in Portugal. That's like the #1 place abroad, all things considered or something. Where would you guys retire if you were retiring abroad?
The problem with going to Europe is they don't have dryers and they don't put ice in their drinks.
No air conditioning.
Yeah. Air conditioning.
Portugal has tiny beers, though. I think those are cool. The little bottles of Sagres beer. It's good.
Yeah,
I'd have to go to the Caribbean. So I'm already wearing a linen shirt, so I'm all set for the Caribbean. I got my Hawaiian shirts. I'd be fine in the Caribbean.
Yeah, I wouldn't pick a country, Duncan. I would live in the United
Bill,
States. I would move to Nevada, like on a big plot of land where nobody would bother me, and I'd get on my airplane in Vegas, and I'd fly all over the world.
You would literally just become a cowboy, basically.
I would, and I would, yes, exactly. But I would love to visit the world. I would love to go to Japan. I would love to visit Colombia. Our great employee, Catalina Castillo, family from there has told me great things about the coffee. And just go see the different parts of the world. As an American, I think that would be a great thing, and spread some patriotism.
Bill's going to take an around the world cruise. I would see everything.
I would love it. Yeah,
Europeans really love it when you show up with a flag and spread that patriotism.
Hey, we did it. We did it in 1945, and we'll be back.
Oh no, he went there. Oh,
1918, 1945. Yeah, about every 60 years we save your ass from some despot. So.
That's true. The least you could do is give us free refills, right?
Yeah, exactly. And
turn
the temperature down in the summer, for goodness sake.
Thanks to Bill Sweet.
So,
I'm glad
yeah,
I'm glad the weather.
Labor Day ranks number 4 on my rankings, right? Memorial Day number 1. I put Labor Day 4. What about you guys? What are you looking forward to this weekend?
It's a long weekend. I don't know. Football.
Okay,
Football. I'm also I saw that there's a drive-in theater up in your area, Bill. I might
Please,
check that out.
it's in my town. Come on
Okay.
down. Give me a shout.
Might
I'll
check
meet you
that
up.
out.
I've seen Twisters, Duncan. It doesn't end well. All
Oh,
right.
God.
Thanks to the tax man, Bill Sweet, as always, the smartest tax person I know.
God bless
Appreciate
you.
all the live viewers here on Twitter, on YouTube. Love the comments, questions. Send us your questions. askthecompoundshow@gmail.com. Leave us a comment on YouTube or a question there. Subscribe to The Compound. Leave us a review. 5 stars, as always, wherever you find your podcasts. And we'll see you next time.
See everyone.
Happy Labor Day.